listening to the Millennial's Choice Show, Canada's most trusted podcast on all things real estate, finance, and entrepreneurship. Here's your host, Matthew Ablakan.
All right. Hello, everybody. Welcome to the Millennial's Choice Show. I'm your host, Matthew Ablakan. We are the most trusted podcast on all things real estate, finance, entrepreneurship. And today we have a very special episode. I have two amazing guests beside me here today. And let me start by introducing Trevor Chew. He's a certified financial planner and the owner of Legacy Financial. And he looks after all of our clients with everything that has to do with life insurance, estate planning, and gives them a bunch of strategies and creates all kinds of things, cash flow plans. And we're going to get into all of that. And then I'm also here with my accountant. He is Ahmad Aslam. He is a senior partner at Zeifman's, one of the top 15 accounting firms. And we have another episode with these gentlemen separately. You guys can go watch those. And gentlemen, how you guys doing?
We're doing fine. Thanks for having us.
Yeah.
Thank you.
Yeah. And
nice to join you again.
I appreciate you guys being here with us. And today we want to look at different kinds of, tax shelter strategies, financial planning. We want to look at people's, investments and how can they plan not only for buying the next investment, but also like what happens when someone who's accumulated a lot of investments passes away? Like how does CRA look at that? What are some things you can do to kind of prevent, high tax liabilities? And you guys are the experts, so I'm just going to turn it to you. So why don't we just get into that? What's like a common mistake people make, Trevor?
A common mistake? Yeah, I think you guys were discussing it earlier, just not looking at the final tax liability. A lot of people are surprised that when they pass away, all their assets are deemed disposed of at fair market value, right? I always tell the story of my grandfather. Like he put real estate into holding companies all over the place, and he didn't have any money to pay for the tax liability. He didn't have any insurance, and we ended up trying to sell those properties in 2008. And not only does it cost you a lot of money, you sell these properties usually when you're under distress and pressure from other inheritors. Usually it ruins or causes some issues with the family inheritance or the family legacy, right, and relationships.
And I guess that's why they call it Legacy Financial, right? If they want to work with you.
Right, exactly, right? It's not just about leaving a monetary legacy, but also ensuring that everything's, set in place and people they're not going to fight at the end of the day,
right,
about the estate, right?
Ahmed, what about you? Like in situations where people come to you and they've had a family member who's passed away, and now this family member has accumulated a lot of wealth. What are some of the common mistakes people will make?
Yeah. So essentially, when somebody has passed away, you've already lost the opportunity to plan for it properly. So these kind of conversations are good to have ahead of time. We do not normally want to talk about that, but as they say, there are only two things certain in life: death and taxes. They might have as well said that taxes at the time of death are also very certain. So you are just to set the stage for you listeners. When a taxpayer dies, they are deemed to have disposed of all of their assets at the prevailing fair market value on the date of death. That means if you have accumulated certain properties, certain investments where they have accrued gains, not realized, so your cost base is much different from what the current market price of that particular asset is, then the deceased taxpayer is supposed to pay tax on that accrued gain. And a lot of people are not planning for it properly. And if you plan for it properly, then there are ways to either freeze that potential tax liability at a certain amount or at certain value, and then pass on the future accrued gains to the next generation. And also, Trevor is much more knowledgeable about how to provide for that potential tax liability by employing certain insurance strategies.
Right. So let's get into that. There's a lot to unpack with respects to all of that. So, I guess how soon should someone look into life insurance, and does that change as they get older? I mean, should it be part of their investment strategy? Like I have people, like even myself, I never wanted to buy life insurance. I never cared for it because I'm a real estate guy. But really, once it was broken down to me by not only yourself, but a gentleman that we work with, Alan Wong, it just became so obvious like how much we need insurance. So like, what do you say to that?
I mean, I really wish I bought this stuff when I was a teenager. I mean, it would have been a lot cheaper. I would have been done paying for like half of them, and they would just keep on accumulating tax-free for the rest of my life. A lot of people don't understand, when you get insurance, you're locking in your insurability, right? So you may be young now, and I never assume because you're healthy, you're going to be healthy tomorrow. I have lots of instances where I've had very healthy people get insured, and then next year, all of a sudden they have type 1 diabetes, or they become uninsurable. And once you become uninsurable, it closes the door to a lot of things you can do, especially if you're going to max out your tax-free savings account. Like myself particularly, I don't have any RSPs. I know I'm going to be in a larger tax bracket when I retire. I have rental income, investment income. I don't plan on retiring from my business either. Another issue is, we can't tell you what tax bracket is going to be 30 years from now. We have a very large deficit that they're going to have to collect these taxes on. So it becomes more obvious that you have to plan for these things, the sooner, the better, because your health could change and it does get more expensive each year.
Right. And actually shifting to that, the deficit, it's, Ahmed, you said it was like an all-time high. Like Canada's in it's the largest deficit we've ever been in as a nation. How do you see things playing out when it comes to taxes?
So I think at some point in time, government is they're gonna try to raise revenue, and the one sure way of raising revenue is raising your tax rates. And I think that's the easiest way politicians go about these things. And so probably you can anticipate future tax hikes.
Right. So, I think a lot of our audience is comprised of like first-time homebuyers, investors. We work with a lot of different builders, developers, also lenders. And a lot of these lenders also invest in real estate. What are some of the ways that they can mitigate some of their taxes and tax burdens? Like, we know life insurance is one, but there's all kinds of life insurance as well. So is it as important to have a financial planner, an accountant on your team, or should people just be trying to navigate it themselves?
Yeah, I wouldn't recommend navigating it yourself. It's a very confusing subject. I train other advisors and even accountants too as well on this subject, because there's so much misinformation out there. A lot of it is Americanized. People don't understand. So it's very important that you work with a cohesive team that's knowledgeable. Work with a broker who works at multiple companies and will shop the market for your best situation based on your circumstance, because it's so unique, right? With the monetary policy, I was going to add in, we've run out of monetary policy, right? You can only lower the interest rate maybe 2 more times. So all you really have is fiscal policy to tax people, right?
Right. And Ahmed, what about you? Like, do you recommend people, setting up obviously a strong relationship, not only with an accountant such as yourself, as well as a financial planner? And are those
Absolutely. I think education is the key. A lot of people, for example, when people think of insurance, they still generally think of a very, very basic insurance in terms of life insurance, right? And people do not appreciate how complex that area is and how some of these insurance strategies are tied to your tax strategies. So it's important to get educated and talk to your insurance advisor, talk to your tax advisor, and find out what solutions, options are available for you.
Right. And for those self-employed people listening, I know they can take advantage of different kind of opportunities that exist, which would involve obviously the setting up of a corporate structure by an accountant that knows your situation so well. And then also speaking to like a financial planner to set up different kinds of things like your CRA health account and dental account, I should say, and other things. So can you guys get into that? Like, what are some strategies or solutions people have access to?
Yeah, so tax-free things in Canada. I mean, you have your tax-free savings account. Right now, the maximum is $75,500. You have your principal residence for now. It's tax-free. And you have life insurance. And you also have the first about 800, 900,000 of private shares that can be tax-free as well. Other than that, everything's just like lottery, bursary, things you can't really invest in.
Right. And Ahmed, what about that? Like same idea, speaking on those topics. How can you help someone structure a corporation or something of that nature to kind of minimize their tax burden?
So essentially, as Trevor mentioned, there are few things we know that there is no tax attached to it at the end of the process. But everything else, you can bet that there is a tax bill attached to it. Anytime you're making profits, you're earning income, you're accruing capital gains, there is going to be tax at the end of the process. The best thing you can do is anticipate that now and try to figure out how to manage that, how to provide for it, or how to minimize it given your objectives over the next 5 to 10 years. So for example, if you're thinking, look, at this stage, at this point in time, I do not need to access cash flow from my business, and I would rather reinvest it. There is a different plan for that. But if you need to access cash in the company anyways, then we have a different strategy to deal with. So it really depends where you are in your stage, in your investment stage, in your life, and how you want to plan for it at that point in time.
Right. And I know you said something earlier about adjusted cost base. So there are adjusted cost base in real estate, but there's also adjusted cost base in insurance.
Right, correct. Yeah. So it depends on the scenario. If it's personal or corporate, they're treated very differently, right? So on the personal level, your just cost base is basically your premium minus your premium, your net cost of pure insurance. So basically, the government has a mortality table, and it's basically their interpretation of 1-year term insurance. And they changed that in 2017 because Canadians are living older. And basically what that did was it made it more beneficial to own a personal policy, because now you can withdraw from a personal policy up to your adjusted cost basis tax-free directly from the life insurance company. Or if the ACB is close to zero, anything you borrow above the ACB will be fully taxable as income. So at that point in time, you want to take it to a lender, collateralize it, and then it's tax-free that way. In a corporate setting, it works differently. So in a corporate setting, if the corporation is the owner, the payer, and the beneficiary, the life insurance benefit, so let's say it's $1 million minus the ACB, let's say the ACB is, I don't know, 100,000. That means 900,000 would be a tax-free dividend, a capital dividend account, which is the notional account by the CRE that allows you to pull money out of your corporation tax-free.
Yeah, and I think for our listeners that are hearing this for the first time, they're adjusted cost based. I think a lot of people, if we're using the example of real estate, you buy a property for $500,000 and then you sell it for 600,000. Sometimes people think that the capital gain is 100,000, but really they're not taking into account like expenses like real estate commissions, land transfer tax, different kinds of things that are expenses that they accumulated, which Ahmed, correct me if I'm wrong, that would change. That would be your adjusted cost base.
Exactly. So it's your original purchase price plus any capital improvements, any expenditures which you did not deduct in terms of your ongoing operations are added to your cost basis. So if you bought something for $100,000 and then you paid, $50,000 real estate commission or whatever is the number happens to be, and then you have, certain capitalized interest, there are other capital improvements, all of those get added to the property's adjusted cost base.
Right.
With life insurance, the adjusted cost base is a little bit different because it depends on the policy you pick, right? So you could pick a term insurance policy. It's going to affect the ACB totally different. So in a corporate setting, you kind of want the opposite effect. You want your ACB to be zero as soon as possible because that means you're going to get a larger tax-free dividend out of your policy. And initially, when the government changed that in 2017, that's what they're going after were corporate policies, right? So with corporate policies, they can be set up a multitude of ways. Typically, if it's an older client, if we set them up with like a special 1-year term insurance and guaranteed a rate, typically we can grind down the ACB pretty soon. I mean, in the past, we've had policies grind it down by the 5th year, 10th year, and that allowed them to take money out of their corporation tax-free, right?
Yeah, and the idea is that like what we're talking about here for those of you listeners where you're like, I don't even know what ACB, adjusted cost base, means and all that. The important thing is to remember that if you're going down this path of investing, it's a long-term journey. And these are things you're going to have to put in place, not only so that you're, protected in the event that someone passes away, but also because one of the best ways for you to make money is minimize your tax burden. That's one of the best ways that people make. Some people make a big mistake when they're not hiring the right accountant, the right financial planner, and they end up paying more than they have to. And this isn't about doing something that's unethical or not within your rights. It's within the tax code, and you're able to take advantage of that. And Ahmed, you could speak to that.
Absolutely.
Yeah.
It's you are entitled to rearrange your affairs to minimize your tax burden. There's nothing wrong with it. And you know what? If you're not doing it, essentially you're subsidizing people who are doing it. So it's important to work with tax advisors, financial advisors who appreciate the whole system, and then can find an efficient and low tax way of going about achieving your objectives. One thing I want to mention, we mentioned this capital dividend account a couple of times in this podcast. Just for the listeners' benefit, it's essentially a notional account with CRA, which accumulates any non-tax kind of income, and it can come out of the corporation to the shareholder on tax-free basis. So insurance proceeds, for example, if you have no ACB and all of the insurance proceeds are added to that CDA account. Similarly, if you have capital gains on account of selling a property, and the 50% of the capital gain, which is not taxable, gets added to the CDA account. So it's important to appreciate what the CDA account is, and then you can access that on tax-free basis. Usually when you draw income out of the corporation, you have to pay personal tax on it. But if the income is coming out of this CDA account, then there is no tax on it.
Yeah. I mean, typically you would get out of the corporation. Like if you left it to your shareholders, they're lucky if they get, 700,000 per million, right? It's going to be lower than that. Whereas using this strategy, if you get $1 out of your corporation for $1, it's going to be a good deal.
Yeah, for sure. So how does somebody go about opening one of these accounts?
Yeah, so you want to make sure if you're going to do this for a company, usually it's done with the existing company, usually it's done with older clients who have an existing business they just want to pass on to the next shareholders. You want to be careful. You don't want to set it up in a company that you're going to sell in the future. So if you don't think that you're going to keep that company around, it's better you don't put it into the corporation right now. It's better you just get your own personal policy. There are ways to transfer it into the corporation later, but the main thing is to lock in your insurability while you're healthy.
Right.
Can I ask a question to Trevor?
Yeah.
Trevor, for listeners' benefit, what if you have a two-tier structure? Can you set up an insurance policy at your holding company level? So if you're thinking of selling, if you have a property company and you want to sell the property company down the road, you might as well, if possible, set up the insurance at the holding company level.
Yeah, so most instances we see are at the holding company level. The only time you'd want to hold it in the operating company or the business is if you're trying to pass shares to the next generation, right? One of the issues is you have the lifetime capital gains exemption, right? And one of the rules is you can't have more than 10% of your assets in passive income. And life insurance counts as passive income. So if you got a large cash value insurance policy in your operating company, it may disqualify you for that lifetime capital gains exemption. So you want to make sure you put it in your holding company. And the holding company is usually where people put their investments, they have mutual funds. But the issue with the holding company is passive income. So it's taxed at the highest rate, 50%. So often people will use a life insurance policy and use those investments of a holding company to fund that life insurance policy. And now they can invest tax-free within the holdco,
Right.
and you still get the CDA benefits as well, the tax-free dividends.
Wow.
And another change recently the government made with respect to access to small business deduction being tied to the investment income in the company.
Right.
Can you use insurance strategies to circumvent that limitation?
Yeah, so you're talking about the 50,000 passive income rule.
Exactly.
So yeah, once your corporation starts making over 50,000, then you're into issues. So one of the ways is yes, instead of earning income that's taxable in the corporation, you just slowly put into insurance policy, and yeah, you can reduce the taxable income in the corporation. Yes.
Exactly, and then that way you can preserve the full $500,000 limit to access that small business rate.
Yeah, exactly. Some other strategies people use, and I can speak more about this, is like estate freezes, right? When oftentimes they'll freeze shares of a corporation, pass it on to the next generation, right?
Absolutely.
And there's also spousal rollovers that you can use for real estate and corporate shares as well.
That's amazing. So like, a lot of people aren't thinking about this. It's such a unspoken about topic, and like you guys said, like you train other advisors about this. It's kind of like advisors that are just thinking about a singular insurance policy, but it's really looking at it from like a holistic view, right?
Yeah, because in something like insurance and real estate, those things affect, like real estate is going to be the largest purchase in your lifetime. And life insurance ties into not only your estate plan, your retirement plan, your tax plan as well. And even I would say cash flow plan, because you can use life insurance as a replacement for fixed income and emergency fund because it's so liquid, right?
Absolutely. And life is busy. We're all busy, and entrepreneurs are especially, they have so much demand on their time. So they're they don't have the time to read about the recent tax changes, recent insurance changes. It's better to find a good team, and they know their stuff, and then you are able to work with them and not worry about having to investigate and staying up to date with all these complex rules and changes in tax law.
Yeah, I know I'm not reading about any of that stuff. That's for sure. So I have to rely on you guys to give me the advice.
Yeah, it's literally another language, both on the tax side and on the financial planning side. It's a totally another language.
What I wanted to ask was, from both of your perspectives, how important is it having a will in place?
I would say it's pretty important having a will. Besides having a will, people don't realize that if you have corporate shares that are pretty valuable, you can also have a private will. So that's set up at the same time you do a will. So usually if you don't have that type of will, your corporate shares are going to go through what's called probate. Probate is a public process. I can go to the court will house. I can pay my $70. I can see your will. And it's open. Your family can see it. And not only that, probate takes a long time to settle. And it costs.
How long usually? Like
a typical probate, 6 months to a year. People contest it, maybe more. I've settled estates before. They've taken about a year or so to settle. And they're fairly simple ones too, right? It depends. Right. If it's more complex, it could take longer.
Right. How about from your perspective, Ahmad? Do you ever see families from people that your clients that have passed away?
Absolutely. So will is critical. Not only that it's important, I normally advise my clients, you must revisit that every 5 years because things change, right? As Trevor mentioned, your private company shares, perhaps they should not be part of your primary will. Maybe they should be part of secondary will. So things change and life is fluid. So it's better to have a will and revisit that in 5 years. I have seen some really horror stories in terms of somebody leaving significant pool of assets for the next generation, but forgot to leave a proper will. And now the families just cannot agree what to do with it. For example, you have a situation where there's a really decent operating business generating significant cash flows, but some siblings may not be involved in the business and they have no interest in carrying on the business. At the same time, there might be some other siblings who are involved in the business and they want to carry on the business. So if you don't leave a clear direction for the family, things are not going to be as pretty. So it's important to have a will and revisit that will every 5 years.
Yeah. Now in Ontario, so previously, if you got married, you revoked a will. So now that's no longer the case. They've now allowed people to do witnessing virtually for wills as well. So things change with wills. You should have it updated. Typically, you want the will you want to appoint an executor for the will, a backup executor, and a guardian for the children, right? There are some nuances, like if you have a disabled child, maybe you want to look into a Henson trust and different types of planning strategies. But typically, you don't want everything to flow through the will. Because anything flow through the will is public. It's subject to that probate fee, which is roughly 1.5% or so of your assets. And then you include lawyer fees and accounting fees on top of that. It gets pretty significant, right? So if you have anything with a name designation on it, a beneficiary, with RSPs, TFSAs, life insurance, anything that allows you to name a beneficiary, you shouldn't include it in your will. Otherwise, it could cause confusion. It could cause it to go through probate, right? Yeah. When you name your beneficiaries, some people, they go overboard with the probate planning. You want to make sure you leave a little bit in the estate, because what happens usually, because insurance and other products are so efficient at paying out the beneficiary, like as soon as a person passes away, we get a death claim, we pay it out in like 2 weeks. So the beneficiary already has that money. But by the time they do the final tax return, maybe like a year later, they find out, I got this tax bill, but there's no money in the estate. And that creates issues as well, right? So again, you want to talk to a professional and get them to count the cost. What is my final tax bill going to look like? How much do I actually need to leave in the estate for all that stuff, right?
So the actual benefit that you receive from a life insurance, right? The death benefit that you get when someone passes away, it's tax-free.
It's fully tax-free. Yeah.
It's fully tax-free. Yeah. So I want to shift over to something you said earlier, and I have it in my own policy, cash values.
Right.
Okay. So from my understanding, I'm paying a certain premium every month,
right? And
the policy itself is now building kind of its own savings account.
Right.
Now, if I want to go to the insurance company and get a loan for those cash values, or if I want to go to my bank and get a loan for those cash values, will they give it to me? What kind of interest would you typically have to pay, if any? And then Ahmed, to you, can I write off that interest?
Okay. So policy loans, so it depends on the type of policy. Typically, a policy loan is done with a permanent policy with value. So you have whole life insurance, and then you have universal life insurance. Universal life insurance, you can choose to just withdraw your investments, or you can take a policy loan. You can go either way. And sometimes they have like a separate value as well. Whole life policies, think of the cash value as the advance of the death benefit before you pass away. I always compare whole life insurance or dividend insurance to like a house, right? Think of the death benefit as the sale price of the house. Think of the cash value as the equity in your house. When you want to access the equity in your house, what do?
You go to the bank,
you go to the bank, you
mortgage.
take a line of credit, home equity loan, you take it out. Same way with life insurance. The difference with life insurance is you're leveraging your most valuable asset. People think it's their home, but if you look at a chart and you look at how much income you're going to make from now to 65, you're worth much more than a house. So when you leverage that, it gives you special rights and privileges. A lot of people don't realize when you take a policy loan directly from the life insurance company, they do not take the money out of your policy. They give you their money. And typically, they have to give you the loan. Okay, you don't have to qualify for it. And they don't ask you to pay it back till you pass away. They take it from the death benefit. Okay.
And they take interest on top of that?
So typically the interest is usually lower than the dividend they pay, if they pay dividends at all. If they don't pay dividends, then you're just paying interest. Usually it's like maybe, prime plus 2, prime plus 3. They're pretty reasonable. If you go to the bank, it's going to be a lot lower as well.
Okay. Can we expense that, Ahmed?
In certain situations, the premium can be deductible, and essentially the insurance policy needs to be the corporate entity which is trying to deduct the the insurance expense needs to be the beneficiary of the policy, and the policy is a required condition for financing. So in certain situations where the bank says, well, look, you are the real success for this business and we're happy to lend you the money, but if you're not around, the company's not going to do as well. So we want you to have that insurance in place so that at the end of the process, if you're not around, there is a certain cash flow coming into the company to pay the loan off. And so the company is now the beneficiary, and it's required for financing. In that case, there's a limited interest premium deductibility.
Yes.
Right.
So typically, the premium is the net cost of pure insurance. So it has to be in corporate setting. You don't typically deduct for individual purposes.
Right.
The only instance I can think of is, that wouldn't even count as a deduction. If your employer is paying your disability premium, your life insurance is taxable. So in that case, if you pay your own premium, but you still wouldn't deduct it, right? In a corporate setting, yeah, you could deduct some of it. Usually what people would do is they set up what's called an immediate financing arrangement. So say they have a business, they have a lot of assets in the business, they need the cash flow, they don't want to tie up the cash flow in a life insurance policy. So what they do is they get this guaranteed life insurance policy and they use that as collateral to run the business. So because the policy has high cash values up front, they can now immediately, whatever they put into their policy, they can finance and take back out. And in those cases, yeah, you would write off the net cost of pure insurance, basically the cost of 1-year term insurance.
Makes sense. So I'm going to give you guys 2 scenarios and then tell me what would be, if all things were equal, what the best way would be to structure an insurance policy and a real estate investment at the same time. So you have a first-time home buyer, a young couple, they just got married, and they buy their first home. They have no insurance, and they've put everything they've got into this first home where they're going to live in. What should they do in terms of insurance? And what about with respects to any tax implications? So
in terms of insurance, I mean, if they just bought a house, their first-time home buyer, they probably put all their money into the house.
Yep.
They're probably going to be strapped for cash. They got to get used to the house and buy
their
furniture.
parents' money these days too.
So for that case, I would just suggest buy simple 10-year term insurance. And the reason why I say 10-year term is very rarely, if the broker's doing their job properly, you're not going to keep it for 20 years. The term market is so competitive. It's currently underpriced by at least 25% right now. Typically by 2 years, 3 years down the road, I can get a fresh 10-year term for you. Same price, sometimes cheaper. So get a 10-year term insurance. People also should consider a critical illness policy as well. Half of foreclosures in Canada are due to disability or illness.
Sorry, before we jump into the tax side of things, for that example, when you say term, that's kind of like if you get like a phone contract with, let's say, one of the big cell phone providers,
right? Yeah,
and your payment is fixed for that amount of time.
Right. Term just means the price is fixed for 10 years or 20 years. That's all. There's no value to it. You're not locked in. You can cancel any time without penalty.
And should you survive past those 10 years, then the premiums you've paid they're gone.
They're gone. Yeah, it's like car insurance. You're just renting the insurance, and that's why it's so cheap. Less than 5% of term policies actually pay out during that term.
Right, and the reason why it's so cheap is because to our listeners, what I've learned is these insurance companies are very smart and they're good at predicting things because of the stats and all the information and research they do. So it's cheap depending on when you're applying and how old you are, because the likelihood of you passing away is low.
Yeah, it's
right?
very low. Yeah.
Yeah. So there's other options for insurance. We have another episode we talk about that with Trevor. So how would that look on the tax side? Is there really anything they could do?
No, essentially life, at that point in time, your primary concern is it's your primary residence. You want to benefit from the principal residence exemption. So you don't want to do anything creative with that. You want to put it in your name, and hopefully down the road when you sell the house and it has appreciated a lot, all of that accrued gain is tax free.
Right. So how does this differ now when the person who's buying the home, let's say it's still sticking with that same example, it's a couple and they buy a property, but it's not their home. It's a rental property. What kind of insurance policy should they be looking at? And then what would be some of the tax strategies they can use to implement to minimize their tax burden?
I would say, just to go back to that first-time home buyer, when you buy a house for the first time, there's a $5,000 credit you can claim on your taxes the next year, right, when you do your taxes. So that's one thing for first-time home buyers. For somebody who's using it for real estate to invest,
like a rental
property, I would say the same thing. If they're strapped for cash, always start with term. And then because you can always convert later to something else if you're not sure, right? The key thing is you want to know like where you're going, what it's going to look like, and sit down with a financial planner and map that out. But just basic, just looking at it from what you told me, basic 10-year term insurance for now. They definitely want to think about something permanent if they're going to keep these rental properties long term, right? Because that's what happened to my grandfather. You keep them long term. You bought them in for $100,000 worth $1 million. You get a huge tax liability you got to pay for. So you want to think about how are you going to fund that tax liability, and life insurance is one of the cheapest ways to fund that.
Right, and just speaking on that, when we're talking term and then permanent, so I got a permanent policy for myself, and that means my policy specifically is I pay the monthly premiums for 8 years, and then I no longer have to pay it.
Right,
but it's in place.
Right.
For the rest of my life.
Yeah.
So what about from your end, Ahmed, in terms of that example, they buy a rental property, should they be putting it under a corporation? What can they do?
Generally speaking, the tax structure is designed in a way that you get taxed essentially the same amount regardless of how you have structured yourself. So if you have put the property in a company and then you're, versus you have owned the property individually, tax rate is essentially going to be the same. In certain situations, it's really, if you're thinking about, reinvesting the proceeds and eventually you're hoping to build a significant portfolio of properties, and there may be some risk, associated with that, and you want to, shield yourself from the risk perspective. And also maybe there's an opportunity to instead of consider that to be passive income, it can be considered active income. A corporate strategy may work better. So it really depends who you are and where you are in that stage and what's the objective of that, real estate property.
Right. So what's probate? When people say probate, what is probate?
Probate is the process they use to make a will valid.
Okay.
Yeah, and that makes it public and open to everybody.
Right. So do you guys, when you sit down with clients, typically it's a lawyer who prepares the will?
Yeah.
Right?
Should be.
But now, should the people that are listening to this, should they feel they have to prepare a will when they have one property? Or when should somebody really prepare a will or start thinking about it?
I would say when you have assets, you want to start preparing will. If you have children, you want to name a guardian. You want to name an executor, because if you don't, it's going to fall into the government's rules and how they distribute things, right? They're going to decide for you if you don't.
Exactly. Yeah. So there is no wrong time to prepare a will. It's always good to be prepared.
Right.
And you can always update the will. It's not that expensive process to update the will. It's, usually if you're working with a lawyer and you already have a will in place and you want to make changes every 5 years, it's not going to cost you a lot. But it really can make a huge difference in terms of how your assets are distributed, how your assets are maintained, and how, for example, even like in case you're too sick to care for your own health,
Right.
your wishes need to be respected, and your will take care of that.
I think a big piece a lot of people miss with the will is the instructions. Like, how do you want the funeral to go? What type of casket?
Right.
These are decisions that are very difficult for your survivors to make.
Yeah.
And if you can make those decisions beforehand, you'll save them a lot of headache, and you give them time to actually grieve.
I personally want to be as controlling as I can in my will, just to give them a hard time. No, just kidding. But just to, you want to be clear. You want to be thorough. I just helped my parents. Yeah.
And that's the key. You want to be clear. You
Yeah.
want everybody to know what your wishes are, and you want those to be respected.
I'm gonna do something in there where I put, I buried $1 million and just don't put the location, and just have them on a wild goose hunt. But I just did my parents, well, not did it myself, but I put them in touch with a lawyer who helped them with their will, because they've never had it. And you know what? It's very inexpensive too.
Yeah.
It's like less than $1,000 sometimes, depending how complicated it is.
Yeah, you want to make sure it's done properly. I would always suggest do it with a lawyer. The costs of you doing it improperly is going to cost you more than if you just go with a lawyer.
Because they have these websites that allow you to do it online, but
I wouldn't suggest it. No, because there's a lot of stuff that you need to consider in a will.
Well, you wouldn't perform like an operation or open heart surgery on yourself.
Exactly.
Like, why do this yourself?
Yeah, exactly. It's better to trust the professionals who are expert in the field.
Yeah.
So besides the will, you want to make sure you have power of attorney, especially if you own property and a multitude. Because even if you're married, your spouse may not take over your decision making. It may be the Public Ontario Trust that takes it over if you don't have a power of attorney. So power of attorney is a living will that you make. Make sure it's enduring and continuing. It's not one of those that you make at the bank. It's one that encompasses everything, right? On your personal health and your personal property. And you designate someone to make a decision for you if you, say, go into a coma or you can't make a decision for yourself.
So that's what I wanted to get into next. So power of attorney. So all I'm saying is that I'm giving power to, is it an individual that I name or?
Yeah. You choose the individual and they have the right to, accept it or decline. So you name a backup just in case.
Okay. So let's use this as an example. Carson is such a great guy. Our video guy, Carson, our production manager, is such a great guy. I want to trust him to make the choice for me. Carson, don't get excited, because I would definitely be trusting Sarah with this. But let's say I wanted to give Carson the power to choose to if I should sell my property, because I'm not able to make that decision. So does that mean like he can just go ahead and do that at any time, or?
Yeah. So usually he'll take that power of attorney and he'll present that to the bank or institution to make a decision for you on your behalf. So yes.
And now that's even if I'm fully okay and healthy and whatever, he has the power to still do that.
Well, typically you have to be incapacitated, and there are limits that you could put on the power of attorney, which is another reason why you should use a professional, because you can stipulate for the health portion, I don't want you to pull the plug on me, or I do want you to pull the plug on me. So you can make a very important decisions in that document, but it's important to talk to a lawyer about it.
Absolutely.
Right. Yeah. So you'd want to make sure that you're giving someone who obviously you trust that kind of power, right?
Right. And you can limit what they can do through that document as well.
Right.
Yeah.
Right. So when you guys are looking at people's files and cases, obviously, Ahmed, we do it for myself, because your firm, you take care of all of our accounting needs. You advise us based on our goals, like what we want to achieve and where we want to go. And then you advise us accordingly. Same thing, Trevor, with insurance. Like you just guide the person to where they should be going based on their goals, right?
Yeah.
So a lot of people, I think, are scared to talk to maybe insurance advisors.
Yeah. I really look at myself a financial planner first, and that's how I approach it, right? I sit down with the client, I get to know them. I do a cash flow network statement first before I talk about anything. Let's look at your problems. Let's look at your goals, and let's look at how we can fix those problems. And if insurance is one of those solutions, we'll show that to you, right? Sometimes insurance is not always the solution. Sometimes it's something else, right?
Yeah.
For instance, for corporations, they can open what's called a health spending account.
Yes.
So oftentimes, people will tell me, how much is a health or dental plan? I'll tell them, you know what, if you're not making large claims, it's not worth it, especially in a group setting. Like if you are a business owner and you have employees and you're paying for a group plan, you're never going to claim more than you pay. And if you do, you're going to get a large increase next year. So typically I'll work with accountants, I'll work with business owners and help them set up what's called a health spending account. Think of it like an RSP for your house spending needs. The corporate funds it with after tax dollars, which usually is taxed at the small business rate, and then the person can use it personally, tax free. And you can use it for a lot of other things traditional insurance will not insure you for, cover you for. Pretty much anything that's on the CRA medical credit list, you can claim. Things like personal care, private nursing services for elderly dependents. So if you got a business owner, and we have a large aging demographic, they got to pay for long-term care. It's very expensive. They could potentially fund that with corporate dollars, right?
Yeah. And also it's a lot, as Trevor mentioned, it's very flexible. So if you are anticipating, for example, kids are growing, and then you are anticipating some dental bills, in thousands of dollars, and may not be in first year, maybe in the second or third year, you can actually fund that plan. And as you make the contribution into the healthcare spending account, it's deductible at the point when you make the contribution. And you may then use that contribution a year from now or 2 years from now when the expense comes due.
Can you guys get into RRSPs? So specifically in two things. Trevor, can you define it? And then Ahmed, can you tell us how people would want to use it to buy their first home, and then what tax implications there are for that?
Yeah, so an RSP is a registered retirement savings plan. Yeah. It's basically just a title that CRA gives you that allows you to invest money tax-free. You can pick anything and throw anything into an RSP. Not anything, but like stocks, investments, mutual funds, you can throw in there, and it will grow tax-free. Whatever you deposit in there creates a tax deduction that year. So let's say you put in $10,000, now you get a tax receipt, you can deduct your income by $10,000 that year. But when you withdraw it, it's fully taxable as income. And that's what a lot of people don't realize it. So if you, put money in this year, you take out the next year, you just might end up paying more taxes than you need to. Another issue is, if you accumulate too much RSPs and you don't spend it in your lifetime, CRA will take half the RSPs if you leave it to an adult child. So you have to also be careful not to buy too much RSP. So again, you want to work with a financial planner, look at your tax bracket, look at what it's going to look like in the future, and then plan your taxes based on that, right?
Right.
Yeah. And another thing which a lot of people don't realize is that the kind of investment you make in the RSP do matter. For example, capital gain appreciation strategies are really great when you're holding them, in your personal name, you're paying 50% tax. But in RSP, it's fully taxable because at the end of the day, anything you take out of your RSP plan is fully taxable. So you have to be smart about what you're putting into your RSP plan.
How do first-time home buyers use it to buy their first home?
So you can actually, there is a way to withdraw, RSP contributions you have made to fund your home purchase, and then you can slowly over the next 15 years put that money back into RSP plan.
And it's tax-free at that point, right?
It's tax-free as long as you make the minimum required contribution over the next 15 years.
Yeah, so it's divided over 1/15. So you pay 1/15 back beginning the second year. If you don't pay it back, it just gets added to your income. So it's not a huge deal if you don't pay it back, right?
And they changed the limit that you can take, right? $35,000?
Yeah, so it's $35,000 now.
Yep.
And a lot of people don't realize, because it's an RSP and financial institutions are not allowed to put a lien against your RSP, you can actually take a loan, an RSP loan or line of credit, put it into your RSP, wait 90 days and turn around and use it as your down payment.
Interesting.
Now, I would only do that if you got a good cash flow and you have little to no debt. And, you obviously want to talk to a mortgage broker first, get them to get you a pre-approval with the RSP loan considered in it, and see if it makes sense.
Yeah, because you could take an RSP loan, and one of the benefits of doing that would be what?
I mean, you get a large tax deduction. I imagine getting $35,000 RSP contribution. You could probably carry it forward. I think it's 5 years. You can carry forward the RSP contribution.
So this is for people. Okay, so you guys have 0 RSPs. You're ready to buy your first home. Okay, you're salaried. For those of you listening, you're a salaried person. You're a self-employed person. It doesn't matter. And if you take a RRSP loan because you don't have cash available to just put into your RSP, you take an RSP loan, you put it into your RSP. So now, like Trevor mentioned earlier, it reduces your taxable income dollar for dollar that year. And then now you can use the RRSP, which is what Ahmed was saying, as part of your first time home buyer, as a part of your down payment.
Yeah, I mean, one of the main benefits I say this is because you want to try to put down 20% if you can, and this strategy helps you do that, because paying that extra CMHC insurance can be quite costly and doesn't even protect you, right?
Yeah. So I just did the math. Tell me if I'm wrong. So if you borrowed the $35,000 from your RRSP and you divide it by 15 years, because the government gives you 15 years to put it back in there tax free, it's an annual payment of $2,333 and like 33 cents or so.
Yeah, and you do that just by purchasing RSPs anywhere.
And now, do they report it? Like if I'm a first-time home buyer and I use that. So guys, first of all, for you listening, you've heard my story. I bought my first property when I was 19. I closed it when I was 23. No one, the lawyer I was working with, the real estate agent I was working with, and the accountant who was a chartered professional accountant I was working with, no one told me about this. I lost that benefit. I never used RSPs.
Yeah, a lot of people don't really know about it or even use it the normal way it's supposed to be used sometimes, right?
Right.
I always encourage people, if you got an employer contributing to your RSP, do it because it's a guaranteed return. And usually with an employer, because it's an RSP, it's vested as soon as they give it to you. So as soon as the employer pays into your RSP, it's yours. You can take it and use it.
It's yours. Yeah. Vested just means that they cannot
withhold it. Yeah.
And with the strategy with respect to borrowing money for the RSP contribution and then taking it out to fund the down payment, it's important that you leave it in the RSP for more than 90 days.
Yes.
Yeah. So guys, for those of you listening and you guys are investing in things like crypto and other assets where like stocks and you're making a lot of money in them, Canada is on an international level kind of being audited by the international community, where these other countries want Canada to put stricter measures in place to combat against money laundering issues and terrorist financing and funds from like organized crime. So for those of you who are making money in crypto and stocks and these other things, when you go get a mortgage, we, as not only as real estate brokers, but even on the mortgage side, our mortgage division, we're obligated to report certain things because the government wants to know where the money's coming from. And even if it's like a stock portfolio and you use that, you liquidate it and you use it as a down payment, the banks want to see 90 days history of proof of funds, which means just show us the paper trail. Where are the funds coming from?
Absolutely. The know your client rules have been tightened around the world. So all the financial institutions have this obligation to understand their clients and understand the source of funds being deposited. It used to be that 15, 20 years ago, there were some pockets in the financial world where you could hide some assets. I don't think that's the case anymore. The tax information exchange agreements Canada has with most of the world are fairly robust. And at this day and age, it's fairly, I think it's you can assume that either CRA has the information or they can get the information if the assets are anywhere around the world. So you can no longer hide the assets. It's better. There is, even now, even though CRA has tightened the rules around the voluntary disclosure program, but there is still an avenue available where you can actually voluntarily approach CRA and disclose your assets outside of Canada, which you have not disclosed in the past. And they waive most of the interest and penalties associated with that as long as you pay the tax owing on those assets. But essentially, there is no tax heaven where you can just hide the assets and forget about it. CRA will eventually get to it. And if they do get to it before you come clean on it, most of that money is going to be gone in interest and penalties and taxes.
Right. And there's actually somebody that's going through this right now where they've kind of just deferred everything from CRA and just taken the approach like my business is a cash generating business and I'm not going to claim anything. But they were accumulating a lot of cash. Like this guy was buying like fancy cars. This and that.
CRA is getting very good at it.
Yeah.
They're known to look at your Facebook profiles, your Instagram pictures, and all of that. Yeah. And they're not shy of doing lifestyle, what's called lifestyle audit. They look at all of the potential, cash you need to maintain your lifestyle and compare it to the income you have reported to CRA and say, well, there's no way you can fund that lifestyle using the income you have. And they're very aggressive about that. So it's better to plan. See, my point is that the tax burden is not that unmanageable if you plan for it. But if you don't plan for it, then these issues can come back and haunt you.
And I think what, we don't sell anything to our clients. We just offer information and they make a decision based on what's best for them. And this episode here, I think what we're trying to promote is more obviously planning ahead, but specifically peace of mind.
Absolutely.
Yeah. Whether it's sheltering for taxes or buying life insurance to, obviously mitigate your family's expenses for funerals and debts and other kinds of things. It's all about peace of mind that you have that in place regardless of what happens.
Exactly. A good insurance policy gives you that peace of mind. Should something happens to me, my loved ones are taken care of. Similarly, a good tax plan gives you that peace of mind that should something happen, everything is in order, my compliance risk is minimized, and I'm not on the hook for any undeclared assets, any unreported income.
Yeah.
I was going to say another tax strategy would be to get this special mortgage. So I have this special mortgage on both my properties. It's a mortgage that's a bank account, a line of credit, and mortgage all in one.
That's what Manual is, right?
Yeah. So I think only 2 banks do this. Other ones are like, they're similar, but they're not the exact same. This is an actual bank account. So you forward your pay into it, it immediately pays down the interest, and they only charge simple daily interest. So it's technically an interest-only mortgage. Those deferrals that people had on their mortgages during COVID, I've always had that on my mortgage, and I always have that continually. If I don't pay my mortgage, I can get away with paying it without paying it until it reaches its equity level, technically.
Right.
So one is a good hedge against emergency, and 2 is a good hedge for tax planning too. If I don't want to take money out of my corporation, it's cheaper to pay the interest. What are interest rates right now, right? Less than 3%,
Exactly.
2%. Yeah. I'm just going to take equity out of my house anytime I want and use that, and then slowly maybe take dividends of my corporation or pay myself slowly that way, right?
So can you explain that again? Like that, explain the mortgage and how it's figured out?
So it's literally a bank account, line of credit, and mortgage all in one. So you take say if you're a retiree or you're working, you take your pay and you forward it into this bank account. As soon as it hits the bank account, you save daily interest. If you get really creative, you use a credit card, you pay your expenses, you get an extra 30 days where the money sits against your mortgage. The result of doing this compounded over the years, I paid off my mortgage in like half the time, and I saved like tens of thousands of dollars in interest. When I compare it to a mortgage that's at 1.5%, even if my mortgage is at 3%, I still pay less interest because I'm pre-funding it immediately.
So the line of credit is there because correct me if I'm wrong, as you're paying down your mortgage,
your line of credit increases.
Yep. So it's called like a home power, kind of like a home power plan.
It's like a glorified revolving line of credit, right? That you can use anytime. And so when I paid off that mortgage, when I bought my second property, so this is good for first-time home buyers. First-time home buyer, I rented out the place, I lived in it, I paid it off, and I used that equity to buy my other place. And oftentimes, in real estate, to waive the financing condition is huge. If you can close on a firm deal, you have negotiating power. And that's exactly what I did. I said, prior to buying my house, there were at least like 4 offers. Nobody could close on financing. I came with a firm offer. I was able to knock off like 10, 20,000 off the purchasing price.
Right.
Yeah. Another strategy tied to the mortgage is if you have significant equity in your business, and on the personal side, you have a mortgage against your property. Mortgage interest is not deductible because it's your principal residence. But there is a way you can extract equity out of your business and then swap it with a loan against a property, and then you can get the interest deductibility on your mortgage.
This is all great stuff. This is stuff that not only saves you thousands. It seems like sometimes, depending on how big your portfolio is, it could be a lot more, thousands of dollars, millions of dollars, but also helping you get to the next step. Right? This was a great episode. I really enjoyed the conversation. Do you guys want to leave our audience with any final thoughts?
Yeah, I would say, tax planning is very important because, our tax system has not been reviewed in like over 50 years, right? It's estimated we pay more in taxes than basic necessities. And so we live in a government in Canada that allows us and encourages us to do tax planning. We should take advantage of it. Other countries, they don't give you that opportunity. They just tax you, and they'll even like throw you in jail, right? So I think it's important for us to do that because we do have a responsibility, right? I think the larger our government is, the more efficient it can become. And we as individuals, we have knowledge, we can see the needs around us, and we're more in tune to that. So if we can tax plan, and I always encourage people to give to charity and to use that as well, and also, give to other needs. I think that plays an important part, to tax planning as well.
Right.
Yeah.
Exactly. And I think the other piece, we talked about it a couple of times during this podcast, was the education. It's important to learn about various opportunities available to you. And if you're knowledgeable about what can be done, and then you approach the right professionals, they can help you plan it, in a much more informed and efficient way than you would have otherwise thought possible.
Right. Well, gentlemen, thank you very much for both of your times.
Thanks for having us.
Yeah, it was a pleasure.
Thank you very much for the opportunity.
Thank you.
Happy to be here.
And to our listeners, this is the Millennials Choice Show, and we're out.